Good morning, everyone. This is Joseph Trevisani. Since, for me, and doing these webinars, if you sit here, you know that's a minor technical glitch when the sound mic is not on. Okay, let us commence. What I want to do is to walk you through the logic that I would use when I was trading as to how to arrive at a trade, whether Australian dollar is the trade we want to take today. Now, normally what I would do is I would run through this with all of the currencies that I was looking at, usually the majors, but not always. But today we're going to concentrate on the Australian dollar. So I'm going to be talking both about the technicals that I see, but I'm going to start with the fundamentals in the background. Because one of the things we always have to remember, and one of the things that I always did when I was trading, is you put things in context. Because without context, especially in currencies, there's no sense. You don't really know what might happen aside from any particular technical move, which is bound and necessarily to be limited in scope and hard to decide based on pure technicals. And I know that there are traders out there, I was never one of them, who keep their analysis almost strictly to technicals. I, one, find that intellectually unstimulating. And two, I don't think it prepares you. The biggest problem is not whether or not the technicals, and this is a daily chart, of course. I'll talk about this in a second. For me, what technicals tell you is very valuable for entries and for exits once to some degree. Entries, absolutely. You are looking for the setup for a move that you can predict with some greater than 50-50 chance will occur. Your goal as a trader is simply to put yourself in the mindset and the mind of the market so that you can participate in any move. And whether or not this is economically sensible, economically relevant, is largely superfluous. Your job as a trader, mine as a trader, is to match our expectations with the markets. The more often we do that, the more successful we'll be. But behind that, the fundamental background gives you, one, the bias for the market. Many times, you're going to be in a situation, so I'm lighting a bit here this morning, a situation where the balances are not clear, where the decision points are not so obvious, and where what you should do doesn't come down with 70% confidence rate. And that is where the fundamentals. Now, as traders and, amateur economists, all of us, the economic background is simply interesting, but it also provides you, as I said, with the balance, with the bias for the market. So let's take a look at what we have here in the Australian dollar briefly, and then I'm going to talk about the background. Then I'm going to come back to the charts, drill down from the dailies, which is where I always start, through to the hourlies, and then to see if we can pinpoint a trade that might be useful within the trend. One of many cliches around markets. I think the three greatest subjects of cliches, I'm not sure where they fall, but the first one of them is certainly cliche, at least in the West. Cliches on drunkenness. There are more euphemisms and more phrases to describe being drunk than almost anything else. Another one, of course, has to do with sex, which we are not going to talk about on a family webinar. And I think the third has to do with money. So we have alcohol, sex, and money as the three drivers of our lives. I think that fits in pretty well with the way some of us have run our lives. We'll not go on any further about this one. Anyway, so one of the cliches about money, which is where I started this, is the trend is your friend. You've all heard it. And guess what? It's true. Because the trend describes the macro background. When I was in grad school, there was a big deal, much more, the terms were much more commonly used to macro and micro to differentiate different types of economics. In fact, they really are the same, of course. Macro is the large picture of the economy, and micro might be some company's returns, because it is quite possible for a company or an individual to have a different economic outlook, excuse me, than the overall. If you were a listen, cliches, it's not a cliche's fault. A cliche becomes a cliche because it has an accurate piece of knowledge, a valuable piece of knowledge. It gets repeated so much so that it gets abused. And then it becomes a subject for wit. That is, people will turn it on its head and stuff like that to make it more interesting. But all of these things are good. It is quite possible for the macro and the micro to diverge. It's actually very easy. If you were a shareholder, take a current example, a shareholder in BlackBerry, then your micro picture for the company is very divergent from the macro picture of the overall tech environment and tech companies. So that's where one of the differences, sort of the main difference, and it's true of an individual as well. You can be in the middle of the boom, but people get fired, things go wrong in their lives, and their picture diverges from the overall boom. So it's necessary and useful to remember where you are in position for the economy. Having said that, let us now take a look at some of the things for the macro picture that are going on in the economy, the Australian economy. We're talking specifically about Australia. One of many things, I have lots of things that I say one of the things for, that it is useful to do, I think, especially with countries and areas of the world that we may not habitually spend a lot of time on. When you, Americans at any rate, but other people around the world as well, I speak for an American and a New Yorker because that's what I am and that's where I work and live. You're most familiar, of course, with the economics and politics of your own environment, your own milieu. That's 17 years of French. I think my kids 2 years can speak more French than I can. And you must remember, and we all must remember, one of the things that currencies help us do, currency trading, is to put ourselves in the other person's shoes. The view from Sydney, from Melbourne, from Darwin, although we, as Americans, share a language, to a great degree share a culture, although we don't drink Foster's as much here, and share a general world outlook. The view from Sydney, certainly on economic topics, is very, very different than the view from the United States, than the view from Milan, than the view from London, the view from Geneva. It's very different. The drivers of the Australian economy, especially now, and especially over the past 15 years, have become, right on top of it, very different than the drivers here. And we're going to see this very, very dramatically in the Australian, just extrapolating from the Australian currency data, which we're going to look at. So let's switch this chart. This is our charting system. It is now called Alpha Trader. We had an office poll amongst the members of the firm. We're a relatively small firm and very efficient firm. Most of the people here, I don't know if you know the background of the company, I'll just touch on it briefly, were partners or members of FX Solutions, which is one of the first and the most successful of the retail trading outlets, the American retail trading outlets. Okay, so let's take a longer look here. Okay, let's look at a weekly, and let's get this going back to, of course, the seminal event of all of our economic lives these days. We know what that is. It is, of course, the crash. You know, we're cleaning some windows in our apartment because we're moving. My family's moving. And we didn't have any newspapers anymore because nobody buys or saves newspapers. Okay, oops, sorry. So going through one of the closets, we found a stack of newspapers that we had saved around 9/11 because I live in Manhattan, and at the time my wife actually worked downtown. And so, as my parents had done over many events, you save the newspapers, you save the copies of the New York Times. Okay, so let me just put this up here. Sorry about the oops. Sorry, story. Okay, so we didn't have any papers around the apartment to clean the windows with. So, because we all consume our news and all of our information now on our iPads and on the web and on our Kindles and everything else. So we decided, in a burst of no sentiment, to use the historical paper that I'd saved from around 9/11. And as I'm cleaning the windows, that was my job, designated and ordered by my wife, of course, I started reading some of the stories and the news from 9/11. And it is only 10 years ago, a little bit more now, 12 years ago, how much the world has changed and how much the world has been affected, and it's just different. Many of these differences would have happened anyway. One of the differences is the tilt of the Australian economy eastward. Australia is an Asian country. It's easy to downplay that fact. So is New Zealand, because their culture is Western. But they are assuredly, geographically, I figured that out by looking at a map, and economically Asian. What goes on, as someone said on the webinar, what goes on in China, it used to be Japan, now it's China, Indonesia, Thailand, Taiwan, Formosa as it used to be called, matters far more to the Australian economy than what happens in the United States, except for financial conditions, perhaps, that might be set by the Fed, that happens in Europe, that happens in South America, Brazil. Australia, for a long time, maybe still, used to call itself the lucky country. A largely unpopulated continent, settled by Europeans, primarily Englishmen. Vast resources. And another, you could say, aspect of their fortune is that they are positioned, and you can just look at their economy. I have some graphs I'll show you. They are positioned fortuitously to provide resources and expertise to the most energetic portion of the world economy. And that, of course, is China, and you could say India as well. Countries that, in their place in the economic picture, are where the United States and Europe was probably in the latter 19th century, growing their economy through all sorts of natural effects. Infrastructure, adding wealth, consumerism, the things that the U.S. and the West did in the late 19th and early 20th century are now there. And these things are absolutely natural drivers of growth. In addition, China has a government, no political comments here, which is devoted, perhaps only for survival, but is devoted to economic growth. So the background for Australia keeps the lucky country idea because, hold on a second, let me just put up a monthly here. I want to make sure we get a long enough chart. Let me just put this up. Okay, so this is a monthly. You know what? Let's put up the weekly. We get a better definition on the weekly. Okay, now this tells us something about the Australian background. Let's take a look at another chart. That's the Australian weekly going back to 2008. Let's look at the Australian GDP. Okay, this goes back to 99. This is a quarterly, yearly, year on year. Okay, now let's look at China. See if we can get two on the same page here, so we have a better sense of what we're talking about. Okay, so here are the two charts, China and Australia. That's not just a coincidental, of which I don't believe in coincidence, congruence. You can see from the charts that you have a very similar type of pattern with a delay tilted over towards the Australian side. Now, this is, of course, not perfect, and it matches a lot of Western and other examination of various economies. But when you factor in the delay for the peaks, then you can get a real sense that what is driving the Australian economy, as many people have observed, is China. China's need for resources, China's stability, China's ability to continue its economic growth. Now, the parallels here, although we have very different peaks, are real. For China, this peak right here, just like in the West, was driven by two things. One, a rebound from this precipitous fall over the financial crisis, and two, the Chinese, I didn't actually bring that chart, but the Chinese loan demand. This is one of the topics du jour very much now about Chinese loan demand. And the Chinese use bank credits and the so-called shadow lending system, the shadow financial system, to fund economic development. Those loans, because that's what they are, they're loans created by various institutions, many of them unregulated or largely unregulated, are then put out into the economy and used to build houses, to build factories, many of which are not doing very much. I think I told people last year when I came back from Beijing, and we did a tour with some of the companies we do business with there. We did a tour around some of the factories, and we would call it in the United States office parks around Beijing. There are all these empty buildings, vast estates, all sorts of things that have been built with this loan money created, compared to the United States, where the Fed has been pumping $85 billion into the economy for what, a year and a half now, and for many years before that in other guises. Yet the money doesn't actually leave the banking system. It stays on deposit in excess credit in the Fed. In China, it's very different. That created money, those loans, actually go out into the economy. And what's the difference? The difference in China, as opposed to the United States, is demand. People are willing to go and do go to the institutions, be they regulated or not, shadow or not, and ask for loans. That's exactly what is not happening here in the United States, to a large degree. Not completely, of course, but to a large degree. So all of the money that the Fed has created, which are really just electronic deposits, is sitting there. It's not being used. So that's a difference between the two economies. In China, there is still demand, attempts to create money. And what is an attempt to create money by the individual who borrows the money? What's their goal? Their goal is to get wealthy, is to make money. That is as trading is driven by the desire for trading profits, much economic activity, certainly the founding and risk-based economic activity of founding a business, is based on a desire to, say this quietly so nobody can hear us, make money. The driver of economic vitality is a desire to make money. We all have to remember that. Okay, so we can see that we have the equivalence here between China and Australia. And if you look for the greatest driver of the of the Australian economy, it is without question China. Okay, now let's look at the comparisons on central bank rates. This is the Australian cash rate. Okay, as you can see, like everyone else, everybody cut their rates, but Australia has cut them from 7% down to 3% for the economic crisis. Okay? Let's take a look at that. Now, look what everybody else did. I'm going to do the BOJ last. The Fed funds, which has been the most active. We have a not dissimilar pattern here. Whoops, sorry. Okay, not dissimilar pattern here. Look at the difference between these two. These are both going back to the same place. This section here, before 2008, is similar. Not the same, but similar. But look at the profound difference afterwards. The U.S. has been on 0.25 for 5 years. It's amazing when you think about it. This now 5 years have gone by since the fall of 2008. We've had 2 presidential elections. A lot has happened. But you know what? A lot happens always on a busy little planet, I guess. So, this is a prime example of the difference in interest rates. Astonishing difference here. Australia is it's a fully developed economy. It's not a developing economy. It is resource-based, but it has a great deal of manufacturing as well. Nonetheless, look at this difference in Fed policy, which is telling you everything you need to. Okay, so that's the Australian. Let's take a look at the ECB. Not quite the same. In fact, you have to question what the ECB is up to the entire time. All of this period right here, they're at 1% right now. Big deal. Might go up and go down. The ECB has a very different creature to deal with. It is nonetheless in a similar situation, but it responded quite differently. Finally, it's down at 2.5% now. The last one we'll look at And this is an example of how not to do things. And in my mind, is a very using the central bank as your main policy, main economic, not financial, but economic, not monetary, but the main economic policy maker is a disaster. This is a 30-year chart for Japan for their overnight unsecured call rate, which is the equivalent of the Fed funds rate, the main refinance rate, or the cash rate from the RBA, Reserve Bank of Australia. If there was ever a better example of the futility, the economic futility of depending on monetary policy for economic growth, Japan is an example. This is 0.1%. Japan has been below 1% since, that looks about late 1994. So what do we have? 20 years. And the Japanese economy has performed incredibly poorly in that entire time. The problems for Japan are not monetary. And also, through a lot of this time here, the yen was below 90, below 100, exactly where the Japanese don't want it. The problems, monetary policy is at best an adjunct to economic policy. It cannot create the conditions for growth. It can help. Well, let's put it this way. It can create the monetary conditions. If there are other problems, it cannot do it. It can, if badly handled, choke off growth by putting rates too high. But in lieu of economic and financial policy that makes sense, monetary policy cannot create growth. This seems to be the most evident thing imaginable, but in fact it's not. And the reason it's not is because it's the easiest effort. Okay? Let's look at the next one here. This is the yuan rate. Now, the yuan is a managed currency, as we all know. We should never pretend otherwise. But the yuan, as we would expect, has been steadily strengthening since 2005. The policy responses of China are dictated by exports. Now, I don't know if everyone saw it, but the latest month for exports, I believe it was February. Chinese exports fell 18%. They were expected to rise 7%. There hasn't been a great deal of coverage of this. Certainly the Australians are watching it for sure. But it fits perfectly with this chart. In 2008, financial crisis, the Chinese stopped appreciating. Remember, managed rate, controlled by the government, decisions made on an economic basis. China is an export-driven economy. Export-driven. Say no more. I know they've been building their retail base for 15 years. They've been talking about it. Hasn't happened. I mean, yes, there's much more of it than there used to be. I remember going down not far from my hotel when I was in Beijing, and you go down to this brand new mall. It was huge. Actually, it was an outdoor mall. Every high-end Western brand was there from the United States, from England, from France, from Italy. They're all there. All the designer stuff was there. And I felt a bit like a New Yorker in Times Square. I live in Manhattan, so for me, Times Square is just part of where I live. But it's not viewed that way from people from the outside, of course. It's a huge tourist attraction. And if you go downtown, I was downtown a couple of days ago, just walking around in Times Square, which I don't do very much. And, of course, nobody there, very few people there actually from New York. They're all visitors from other places. But that's exactly what this mall in China was like. And even though I'm not Chinese and don't speak Chinese, it was very, very easy to tell as a confirmed urbanite, which I am, who was visiting from other places. In New York, other places in the United States or in other parts of the world, and in China, primarily from other parts of China. So it was fascinating. I mean, there were all of these people at this mall, which apparently is quite famous, from other parts of China, from rural China, from mid-20th century or early China. It was fascinating to see the changes in Chinese society engendered by themselves. I mean, an attempt to change their country, to make it grow. And probably what happened in New York in the 1920s. That's where all the jokes about farmers and groups and everything else come from. But despite that, the Chinese economy is primarily and predominantly dominated by export industries. That's just the way it is. It hasn't changed. It's not going to change. So, why is this important? Because the Chinese government is determined to keep growth going. This is their only chance. This is their source of legitimacy. I mean, they're not elected government. Their power stems from their ability to deliver economic growth. What do we see here? I'm going to go right back to Australia with this, okay? Chinese stop their fixed band, appreciates. Appreciation for the yuan is a result of a number of things, but primarily it's just the growth of the Chinese economy and the desire for people to do business there. The Chinese let the yuan appreciate for a couple of reasons. One, because it eliminates some of the pressure. If they don't let it appreciate, then the Chinese have to keep buying dollars, as in treasuries and everything else, to keep the yuan from appreciating. It helps the economy in some ways because the Chinese buy a lot of imports from overseas, primarily raw materials and other partially finished goods for assembly. And so, of course, a stronger yuan helps that. And finally, a stronger yuan helps the domestic retail economy. If you want to buy a Ferrari in China and your yuan appreciates 20%, well, you're going to be 20% to the good on the euro, hopefully. So all of these are factors. What happened in 2008? Appreciation stopped completely, came to a halt. Much as, what else did they do at the time? If you look at the time, I don't have the chart, created loans shot up like that. Okay, so clearly the Chinese policymakers are telling you what they view as a danger and what they're going to do about it by the manipulated yuan rate. What happened just lately? The yuan started to depreciate. The Chinese are worried about something. And they are looking for an edge on their exports. That's why they permitted this right here. Okay, how does this fit to the Australian dollar? Well, let's take a look. Okay, so this is the Australian dollar. This goes, what chart? This is the Aussie. Oh, sorry, this chart. Oh, here it is, this one. Okay, that's Australian GDP. Let me shut that down. One of the things about doing charts live like this is, okay, this is the weekly, okay? So, through much of the period here, this rebound, of course, is a rebound from the profound safe haven play made for the U.S. currency and to some degree the Japanese yen. Although my argument about that is very much related to the cross, I'm not going to go into that one right now. And it's very much a minority view. Everybody else says, up, up, up. The yen is strengthening. Hey, safe haven, safe haven. I've never bought it. I still don't. I think it has to do with the translation over from the euro yen. Believe that alone. So this rebound here is, of course, just the money coming back out, to some degree, the money coming back out of treasuries and other safe haven plays. This strength here, up to 1.08, is largely related to what we saw in China. Let's take a look at, so we know what the trend is. So let's now drill down. Okay, we have the basic background. Now, I'm probably not telling anyone a lot that they don't know, although hopefully I'm adding in some detail and giving some logic for it. And by the way, as anytime I do my webinars, if you have anything to say or would like to discuss anything, please just bring it up and I will answer it as best I can in the conversation we're having. I prefer to treat these things as a colloquium, harkening back to my grad school days, as opposed to a lecture. Okay, so now we know what the overall trend has been. This, let's take this back down. So we're going to put a year on it. We don't need 5 years. We know what was going on here. This is one of the disadvantages of doing these live presentations like this, because you have to keep adjusting the charts to take a look at it. So we're going to look at a year here, more or less. Okay. Okay, so this is a year. Let's put it on a daily. Okay, so this is a year. So, going back about a year, what have we had over the past year? We've had a drop in Chinese GDP. We've had lots of questions surface over that, and that has been the greatest driver of, or the greatest correlated driver of the Chinese, of the Australian dollar. Now, we just looked at the yuan, which has gone down deliberately. Remember, this is a managed currency, which has gone down recently. So now what would we do? Let's take a look at the chart we have. Let's draw a trend line here. I like trend lines. Okay. So it's a pretty nice line, right? So based on that, we'd have to say we're still part of an uptrend in the Australian dollar. You can make sort of a question about what you have. I mean, if you take this to here, or this to here, or even this to here as a Fibonacci, let's see if we have this, what I would consider a profit-taking bounce, or we have a change in the background, in the trend. Let's look at that first. Okay, so let's do this recent one. Let's see if they fix this one. Okay, they didn't. Okay, so this bounce, okay, from here to here, right? That's the run. This goes back to last October. From about 97.56 down to this little box to the left charts it out to 86.50 or so. Okay, that's the rundown. Largely connected with worsening figures and concerns out of China. As far as that run goes, we don't even have the 38% retracement. And normally when you get a trend reversal like this, or whatever the reason, if you get a profit-taking reversal, it usually goes somewhere between 38 and 60, somewhere around 50%. When you get a trend reversal, of course, it shoots all the way back up because you have a different scenario. Now, I don't think that's what's happened here. I think this is primarily a profit-taking reversal. Okay. So, based on this, we would seem to have a reasonable, now keep this in mind, a reasonable chance that this trend is going to continue. Most reversals make it to the 61.8% Fibonacci retracement. We're a long way from that. We barely broke the 38%, and then it reversed. If you take a look here, you can see that that has actually worked pretty well as a top so far. Also standard. When you get reversals, people will take profit on change based on the Fibonacci's. In my mind, most of the value of Fibonacci is that it gives you an indication where people are likely to start taking profits. For a reversal from the bottom here, some people will take profit here, and some will wait till you get here. And of course, a few are going to turn around and then make this a point to go short, knowing that other people who were long, and the vast majority probably are going to reverse. Okay, so we have the Fibonacci's. Let's X those out. Okay, now what we're going to do is we're going to switch to the hourly. So what we have here is we have a trend running up. Reversal trend primarily. What would we do to take a look at current trade potential? To do that, we have the background set here. We talked about economics, we talked about macro, we talked about China. We looked at the dailies, which is where I would always start to see what's going on. And don't forget what we have seen from the yuan. Let's take another look at that before we forget it. Where's the yuan? Right here. This little dweeble down here. What is a dweeble? I don't know. It's a word I use for my kids. Knowing that the Chinese, their history, use the yuan as an economic fact for their economy. They have an export-driven economy. Weaker yuan, not yuan, helps their exports. So you have a pretty substantial, and remember, planned, done by the Chinese central bank. Okay. So let's go back to the Aussie. And now we have an hour. Okay, this goes back here. Okay, so let me just get a little more time on this one. We'll go ahead and store it. The other chart went back. We saw the move going back in the fall, going back to October. So that's where we're going to go with this in the hourlies. Okay. Now, this is the fall we saw before. If you look at the top of the trend line, where's my trend line? Here it is. Okay, you can see the break right here. Okay, this was the fall. We had the break right here, and we've stayed above that. So we have stayed above the break point. Break point was approximately around 89. We have stayed above that since then. So we know that this has validity, and we have a base to work with. If we draw this line right here, we'll see a base right around 89. Okay, now let's take a look at the opposite trend. We could draw it from here. Oops. Okay. Draw it from here. Oops, when you get off chart, it disappears. Okay. Okay, we can draw it from here, which also works very nicely for the bounce. Okay, remember, charts are indicators. They're not formulas. They're to tell you what is the rest of the market is thinking and what you're thinking. Okay, so we have this bounce here. Okay, now we have the reversal. We saw this on the dailies. We have an uptrend. This got up to about 38 and is backed off. Now, let's take it very close to where we are now with these things in mind. The break of the downtrend, what's going on in China, particularly the reversal engineered in the yuan. And let's take a look at a much closer factor. Let's look at the year to date. Okay, we're just going to look at what we're seeing pretty much since January 1st. Okay. So now we have this defined pattern here. We know there's a trend line going from here to here. We also know that around this time, right here, the Chinese reversed their currency policy. And in my mind, that is the most important fact we're dealing with. That we can draw this one like this. Remember, charts are made to approximate what's going on. And then we have this right here. So if we're looking right now for chart placement, remember it's today, trade placement. We can't do this one right here. Now, if you would see the problem with this chart line right here, watch. If you had, I attached it to this point here, but if you're over here and you know that the Chinese have changed their trade policy, then where would you draw this line? You would start here, but we didn't have that point. So we would have to go on information that was available to us then. And that would have been moving this line right here. Come on, chart. We would have had to go to this point here or to this point here. So if we went to this point, we would end up here. If we went to this point, we'd end up here. So we're probably going to be basing, if we were basing a chart move, a position on this chart, we'd probably be down here someplace, which you probably would have skipped that little dip right there and put it right there. Okay, so that doesn't give us a lot of help as far as placing this, but let's look now. So I'm going to drill down even further. I'm going to get the hourly, but we're going to draw it closer. What I want to get is this area right here, because this is what we've got right here, right? From, say, February, from this move up. Once we establish the bottom around 89, the figure, that's the market we're living at. Black Hat's absolutely right. We've been rainbound since then. Barely a figure and a half, from 89.80 down to probably 89 a figure, okay? So first of all, let's drill down a little bit. And I'm going to take this to February, I think to the, okay. Okay, now we have kind of a different, excuse my language, a different level. Okay, we could say that's the bottom 89.02. This is what we're dealing with now. So we're looking for trade placement now. Knowing the background and knowing that the Chinese have decided to devalue their yuan. Let's take another look at the Chinese, just because there's some detail I want to point out. Okay, now, what do we have here? You know, I'm sorry, I should have gotten greater detail on this one rather than long term, but I wanted to talk about the macro for China. But in fact, we're talking about, if you will, micro for China, because the Chinese have stopped their, temporarily at least, have stopped their devaluation. And although I can't prove it because I don't have the detail, I will bet you that, which one is this? Okay, let's close that one. And why don't we switch back? Anyway, this is one of the drawbacks of doing historical charts. As you conduct the webinar, you've got to continually redraw the charts. You can't just go to already prepared slides. Okay, let's do February. Okay, January 31st on the dailies. Okay. And let's just draw a little bit more detail here. Take about a month. Sorry about that, but this is sort of the inevitability of doing charts this way. Okay. So right now, This is our hourly. This reversal is most likely tied to the stabilization in the yuan. Or actually, I put it differently. Let me put it, okay? This period we have right here, let's go back to the dailies right here. Okay, let's expand it a little bit. Okay, that's November. Okay. This is the period we're talking about right here. This line up right here. Okay. This right here, these last columns right here are largely tied, I think, it's hard to prove actually, to this, to the devaluation of the yuan, which is an indicator that something is going on in the Chinese economy. Okay? So, let's decide now what we're going to do. We're in the middle of this band right here, 90.40 to 89.02, a figure and a half in the Australian dollar. Do we have any good indicators from the chart, from the charting action, aside from this? Now, we can be fairly sure that if we break through 89, the figure, you're going to get a reversal back into the prior area. What are the possibilities for that? What's driving this improvement right here? Well, the Australian economy has been doing better. The Bank of Australia, the Reserve Bank of Australia, has said they're probably finished with rate decreases, and there'll be an improvement or an increase in rates. So that might sometime in the future. The Australians have just elected a new government. Tony Abbott is the new Prime Minister of Australia. Defeated John Howard, I think. So you have a new government there. Glenn Stevens continued over, much as Ben Bernanke continued over from Bush to Barack Obama. So you have a stronger Australian economy, and that definitely plays into the reversal that we saw in the dailies. You have the Chinese, although concerned, continuing to talk and continuing to act to support their economy. Okay, let me see if we have any questions up here. Okay, let me just answer a question or two here. Yes, it has been. I haven't noticed about any particular pronouncements of the RBA on a particular level, as in 85. If somebody did, they may let me know. I didn't see that. Excuse me. Okay, so let's look at our trade here before we run out. So, that's the logic we have behind it. So, certainly at 89, there is scope for trade. So if I were looking at this now, right now we're at 89.60. 89.02 is only 50 points away. You have some congestion through here, but by and large, since early February, we're now in March, a month ago, month is prime time for this type of, or prime expanse, prime period, for this type of trading. So the first that I would look for would be a short position somewhere around 89. Probably a little bit before, 89.10, 89.15 with a stop probably around here, about 89.40. And then a profit somewhere around here. See this long run up right here? That's 1 hour. Whenever you get a move like that, you know it's the old idea, the old cliche of markets gaps will be filled. What does that mean? Gaps will be filled simply means that when you gap up or gap down, there's been almost no trading in that period, in those levels. If there's no trading, there's no inherent interest. Nobody has any shorts that they want to close. Nobody has any longs that they want to close. There's no interest. So the market, when it gets to the level, almost always returns to the starting point, where you then again have interest. At the very least, you're going to have new orders bet down there buying up the gap. So the same thing is true, although not as forcefully, when you get a very rapid move like this. This move from 20 to, originally it's up to 40, but it really continues probably up to here, was very rapid. So there's going to be a lot less emphasis on it when it comes back down. Meaning, if I set myself short at 10, I would put my profits somewhere down around the bottom of this hourly. Now, once I did that, and once I was short here, now we have tried how many times on this? One. Look at the drop here. Rapid drop. Look at the pattern on the chart here. Most, not all, but you have an emphasis. Look at this. You have a lot of long drops. To me, that tells you that the markets and traders are a bit wary of this and more disposed on technical levels to take a short position. That would certainly be true if and when the market returns to here. So my take, now we're going to have to end right here. My take on all of the, please question my thesis. Go right ahead. You don't learn anything if you don't listen to questions. Yes, I suppose it is selling into support. The support you're going to find is right here. I agree with you on that. However, this support is limited, in my mind, and if you're looking for a position to take to gain a figure or two figures, I mean, right here, we have a potential for almost 2 figures on the downside. In addition, you are right, there is support here. There's no doubt about that. But how many times have we tried the tops and the hourlies? And does it seem, especially when you remember that there's clear concern coming out of China, as evidenced by their devaluation of the yuan for what's going on there, that without a strong China, there is no strong Aussie dollar. That just doesn't happen. Not in this world right now. So when you balance both the potential for having tried the top several times, for 89 or so, including this level here, after all, you don't get a level unless you're going to get support. As you come up, resistance becomes support. You all know, everyone has heard this cliche. So, although I agree with you, it doesn't seem to me when you add the weight of the potential out of China for concern, that the potential risk-reward is much greater on the downside. If you go 89, the figure here, focusing on your support, you're probably not going to do much better than about 90 or even less. If you look, we have a top here, and we have declining tops. This barely made it back to that one, and now we're headed down. So you have lower highs. You have a support having been tested several times. You have some moderate resistance support beneath it, and you have the factors out of China. So if I were looking to make a trade prep on the Australian dollar, that would be my choice. Now, other analysis works fine, but that would be my choice and my logic behind what we're doing. Okay, everyone, I hope this was useful as far as my own trade logic goes and how I would analyze the situation that I was just coming to. I deliberately did not really look at the chart beforehand, although I'm aware of the background of what Australia's generally been doing. So I could approach it, work out my logic with everyone here. Once again, I hope this was useful as if not an examination of my mind, at least an examination of trading procedures. Once again, I thank FX Street for providing the facilities for us to do this. We will have another webinar later in the month. That will be on a macro topic, not on a specific one. So I hope everyone enjoyed this. Everyone have a lovely day, and we will see you in about 2 weeks. Take care. I'll put my email up there. If anyone has any comments or questions, please be glad. I'll be glad to answer them. Thank you all very much for attending.